there's inflation, sort of everywhere, right? It's starting to come down, but coming down just means it's getting to a more normal level, and we're still all adjusting to changes over the last several years. I'd note to the insurance brokers, this is like selling any other insurance product. You have to know it, you have to understand it.
Welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. In this podcast, sponsored by First Insurance Funding, I talk with Ben Rubin, Chief Risk Officer for First Insurance Funding and Wintrust Life Finance. Being a bank-owned premium financing company means that the economic environment, especially changes in banking, is a major factor in the business landscape. Ben discusses the particulars of the financial services environment and how it affects his business.
It's important to think of premium financing as part of the financial industry, right? It's not a standalone part of the financial industry. It's reliant on funding, right? And so funding can come in a bunch of different forms, whether it's through commercial paper. Some of the competitors in the premium finance space use securitizations, which are funded off of commercial paper. Others are bank-owned, as is First Insurance Funding. And we are funded essentially with deposits, right? And so when you think about how the economy is changing and where interest rates are going, that has a direct impact on premium financing as an industry. Additionally, there's the opportunity for companies, borrowers to do other things with their funds, right? And part of the reasons they might want to use premium financing is to use those funds for other things, whether it's investing, earning interest on their deposits, or maybe they have commitments to their current banks to keep a certain level of deposits. All of those things come into play. So, the changing interest rate environment, some changes to just banking in general, where deposits are becoming scarcer. And you think back to the bank crises of early 2023, put a lot more scrutiny from regulators on how banks are managing their deposits. And again, that higher interest rate environment is bringing people to do other things with their funds and to invest them in different ways. And that's taking some of the checking account and free deposits that the banks had out of the system a bit, right? And so when you think of all of that, it's a changing landscape and financial services in general. And premium financing is definitely a part of that. It's interesting because it's not dissimilar from the changes taking place in the insurance industry in terms of policy premiums and where things have gone in that space. There's inflation, sort of everywhere, right? It's starting to come down, but coming down just means it's getting to a more normal level, and we're still all adjusting to, sort of the changes over the last several years. So it's not dissimilar from talking about changes to insurance premium rates. I mean, one of the benefits of using premium financing, particularly as insurance premiums are going up, is it helps customers manage their cash flows, right? And where all of their expenses, whether it's salaries or insurance or rent or travel and entertainment, whatever it may be, all of those expenses have gone up. And there's usually a lag in growing your revenues. You can't grow your revenues as fast sometimes as your expenses go up. And so they get pinched a little bit, right? And premium financing can help them retain the same levels of insurance coverage that they've had, even though the cost has gone up, by spreading out the payments, right? It's not as big a cash burden at one time. Because that's a big piece that borrowers, that operating companies have to work through is just, they see that higher premium bill, and do they want to pull back their coverage, right, and reduce the coverage levels so that it becomes more affordable on a risk per premium, or risk premium per dollar perspective. But premium financing can help them work through that and help them get a little bit more coverage or retain the same levels of coverage and manage their cash flows appropriately. So that's one of the things that the brokers will think about as if they talk through this with clients is really just what are they trying to accomplish with the premium financing? It can do a number of different things. Premium financing can help a customer just put a liability with the asset that's being financed, right? You don't use your line of credit to buy a car. You take a car loan and match that to the expected life of the vehicle, right? In this case, you're taking a very short-term loan, typically for premium finance loans, on a 12-month policy. and you're not using your borrowing capacity that you have with your bank or your line of credit or against your other assets, you're doing it specifically against the asset you're financing, which is the insurance policy. So it just sort of lines things up, right? And it can be a benefit to customers who just want that to match the asset, right, from a financial standpoint.
Mm-hmm. Have you guys seen a lot of increase in that as we've watched sort of property premiums go up over the past few years?
We have, and it's not just the mom and pop, I'll say smaller businesses. We've seen it on, seven-figure premium accounts, right? It's larger property customers. It's some of, more public companies are using premium financing.
Oh, interesting.
In part because when you think of the APR, the annual percentage rate that applies to a premium finance loan, while it might be a higher percent, the loans amortize so quickly, right? It's a 10-month or 9 or 10 month, loan typically. So even though it might be a higher rate, the actual amount of interest you pay is not that full amount because the full balance isn't outstanding for 12 months. It's the average duration is only 4.5 months. So it's more important, when you're looking at these with clients to help them understand, look at the actual dollars, as opposed to the rates, because again, the loans amortize so quickly that the actual dollars aren't as significant as the interest rate might look like to a customer. So it helps them to put it in perspective as they're managing their balances and cash flow, and particularly if it's allowing them to get those higher levels of coverage or retain those higher levels of coverage. And again, it doesn't impede their ability to use their other assets, whether it's, real estate or their hard assets or their equipment, to get regular, more traditional bank financing, right? Because this is a very specific asset that's pledged. And a lot of borrowers like it because there's no UCC filing. There's nothing out there to let the world know you financed your insurance versus a more traditional bank loan. Those things show up, and if somebody's looking at your company, it's more obvious. Ben goes on to share how brokers can position premium financing in the current environment, considering the benefits to using it, the different options it provides, and how different sized companies might use premium financing in different ways. The biggest benefit to the broker is really, this is a sizable industry in terms of premium financing, and to make the assumption that that your client wants it or not isn't always a great assumption. And so if you think about it, you're going there and you're providing your knowledge and your expertise and sort of managing risk within a company, and really, around financial risks, et cetera. And you're talking about, the right levels of coverage and the costs associated with those. And you're giving them, a nice quote on a number of policies typically. Now, if the next broker comes in that's been trying to take your account, or you're both bidding on the same account, and they're equally as knowledgeable as you are, have a great relationship, have been calling on this customer the same amount of time you have, trying to get the business, and they offer the similar coverages and similar costs, but they offer the premium payment plan with a premium finance agreement and you haven't, that's one more thing that they've brought to that customer as an option. Whether the customer wants it or not, they might just be viewed as somebody who's, just got one more arrow in their basket than you've got, right? And so in their quiver. So, it's one of those things of there's no risk in offering it, not knowing what the borrower's or the insured's financial condition is, or what the other use of those funds may be for them in their business. Maybe they're thinking about adding another client, but it's going to stretch their working capital, right? And by just giving them this option, you might free up that opportunity for them. Or maybe that's buying the next piece of equipment, and they may have thought, well, I got to pay my insurance now. I'm going to wait 6 months, and that could slow the ramp up of their business. So some of those things that if you're just not aware, by not offering it, you sort of have shot yourself in the foot a little bit. So that's the biggest thing, from my perspective, is just, why would you not offer something that's readily available that most people in the industry would offer at the risk of losing business to somebody else? So that's one, just in terms of how brokers should be talking about it with clients. It's really just about that, opportunity cost of using working capital for other parts of their business. If you've got multiple carriers that are offering different policies, how do they manage their accounts payable? Is it very cumbersome for them to be issuing multiple checks to different markets, on a regular basis? Or maybe some want to be paid upfront, some want to be paid quarterly, some want monthly. All of those things come into play, and it just, it's a lot of times easier just to consolidate it into that one payment, which is premium financing can do. So, um, a number of different reasons to sort of think about why you might want to do this. So,
Mm-hmm.
there's aspects of premium financing that some brokers aren't aware of, which is the ability to even in a workers' comp type auditable policy, to be able to work with third parties that will help track payroll for the customers, and sort of you can have sort of adjustable premiums within a premium finance contract so that we can sort of stay ahead of that audit issue that can come up at the end of workers' comp. So it's a more limited number of our borrowers, insureds, sort of use that because it does take a little extra work on the customer side, but it's a great way for particularly smaller companies that have, audit risk, right, on those worker comp policies where payrolls are changing or the classification of workers may change, to help them manage that. So there's not a big check due at the end of the policy, or it can be very helpful to the broker relationship as well as to the insured.
As Chief Risk Officer, Ben shares his thoughts on regulatory risk as well as which industries are worth noting from a risk perspective. And he has some final thoughts for brokers considering adding a premium finance option to their offerings.
Well, there's a few things we think about within premium financing from a risk perspective. One is obviously our regulatory risk, and whether it's the various states' Department of Insurance, but from aside from the regulatory risk aspect of it, the things that we look at within our portfolio are really just how much risk we're taking in terms of credit terms that we're offering. What we're seeing in terms of trends of industries that we finance. If you look out there in the market across insurance, transportation has been a challenge over the last couple of years. There's been a big supply demand transition there post COVID. So we've seen that come through our portfolio, and obviously work with our customers, with our agents, with the insureds to make sure that we still support that industry with premium financing, but do it in a way that limits everybody's risk.
Mm-hmm.
And then certainly there's, just based on the claim activity within transportation, right? There's been changing approaches from various insurance carriers in terms of minimum earned provisions or loss sensitive premiums, and right. And we have to understand all of that risk because the insurance premiums are our collateral, right? If somebody doesn't pay their premium finance bill, the sole piece of collateral that the premium finance company has is the policy, right? And so understanding those premium earning provisions is really critical to us. So we've spent a lot of time looking at some specific carriers that have done things a little differently than the rest of the industry, and we need to understand that and make sure the agents that we work with understand that as well, because it affects the terms that we can provide in order to manage our risk appropriately. So in terms of that, so we're always looking at just sort of that industry risk and sort of what's going on, and making sure that we're able to continue to serve industries and to continue to serve clients. I mean, our goal is at Wintrust in general, but specifically in premium financing, is to never jerk the wheel. We want to be able to gradually change in line with the environment, and to continue to serve customers across the spectrum, and never be the ones that have to say, uh-oh, we're too far off course and we need to make a hard right. If we're doing things correctly, you're never doing anything that's terribly unexpected. You're just moving the needle a little bit to get things back in line.
Mm-hmm. Any other industries besides transportation that you have had to pay particular attention to recently?
That's been the one that's probably been the most challenging over the last couple of years. The other is, there's always pockets. We're a national company. We're doing things all over the U.S. and in U.S. territories. We do have a sister entity up in Canada as well. And so, there's always different regional issues, whether it's emergency orders related to weather activity, fires, things of that nature that can impact, the ability to cancel policies, or certainly has impacts on changes to the insurance carrier's financials, and that's something that we look very closely at, where we're seeing carriers struggle, because we do have to look at them as sort of the ultimate backstop on these loans. If the insured fails to pay, we're reliant on that insurance carrier to be able to return premiums to us. And if they become insolvent, that becomes a challenge, particularly in the E&S market, where they're not backed up by state guarantee funds. So, we're attentive to all of that, sort of nationally and even internationally into Canada. No specific industries, just sort of those geographic issues. I mean, COVID was a challenge, as it was for everybody, but particularly in insurance, where you really weren't sure at the outset how customers, borrowers were going to perform until sort of PPP came out, and you had emergency orders being issued all over the place by various states. So that impacted our collateral. So there were a few months there where we were very concerned, but as was everybody else around a number of things. We have the benefit too of we're a national bank. We're talking to our regulators, which are part of the OCC, the Office of Comptroller of Currency, and they're part of the Treasury Department, right? So you're getting some insight from them as to what they're seeing across the regulatory landscape and what they're seeing at other financial institutions, and hearing sort of what Treasury might be doing to assist the economy. So you get a little bit of that. And we were, during COVID, having regular conversations with them, as were all banks. So it's helpful. It's always good to have good relationships with regulators that can help you understand what's going on and from their perspective. One thing I'd note to the insurance brokers, this is like selling any other, I'll say, insurance product. You have to know it. You have to understand it. You have to know what your obligations are as part of the arrangement, right? I mean, similar to risk that you have on placing policies and making sure that you've got the right coverage in place, and that you understand and have explained to the customer what the what the exclusions in the policies are, et cetera. I mean, one of the things brokers need to make sure they're doing when they're working with premium finance companies is disclosing those policy terms to the premium finance company as well. Whether it's minimum earned provisions, extended days of cancellation, things of those nature that impact how a policy can return premiums, pro rata versus short rate. Those are key pieces that need to be input correctly into the premium finance agreement, and the agents and brokers sign those premium finance agreements representing and warranting to a premium finance company that all of the information is correct, right? So you don't want to create exposure for your agency by not paying attention to those details, and it's also, you can put your insured in a bad place if the collateral performs differently and they decide to cancel coverage and replace it, with another carrier, and now they've got a shortage on a premium finance loan because some of those terms weren't disclosed correctly, and terms weren't appropriate for the types of policies, the way that they earned, right? So it's just something to be cognizant of, and it's sort of, also similar to when you're placing an insurance policy, the broker earns a commission, right? Because they have this fiduciary duty. They're in there selling and understanding the client's needs and making sure that you're getting the right types of policies. Similarly, there's the opportunity to earn, income in most states, for, providing the premium financing, to clients, similar sort of commission type structures and things like that. So, there is that opportunity to earn income, right? And so why wouldn't you, want another product in your arsenal that you can offer as another added, piece of revenue for your business.
That was Ben Rubin, Chief Risk Officer for First Insurance Funding and Wintrust Life Finance. I hope you enjoyed our conversation. For more Leaders Edge podcasts, go to leadersedge.com.